Hello everyone, Merry Christmas! Welcome back to my channel. Last week, S&P 500 aka the broader stock market held up after a turbulence week. However, several big names such as Tesla, Apple and Nvidia tumbled. And as we approach the last few trading days of the year, some are wondering what can we expect from the stock market. Are we still going to have a center rally, which usually stretches from Christmas period to the first few trading days of the new year? Well, I have some interesting stats and trends to share with you in this video. Concurrently, I will also share about my own take and view, therefore do stay on to find out more. Okay, the stock market was rather weak for almost the whole of last week. On Friday, despite S&P 500 and Nasdaq went up, they still posted a weekly loss as fear of a global recession continues to battle investor sentiment. Big players such as Apple, Nvidia and Tesla are showing massive weakness. Apple tumbled about 2.4% in the past week and almost tested June's low of about $128. For Nvidia, it fell about 8.2% since I shared about the bearish shooting star candlestick in my last technical analysis segment. More on that later. And then we have Tesla. The stock plummeted close to 20% in a week. Note, in just 1 week. How crazy was that? Well, clearly and evidently, 2022 has been one of the worst years for growth and tech stocks. To add on, other than a global recession fear, investors were also selling stocks for tax loss harvesting purpose, a strategy that involves selling assets at a loss to offset capital gains taxes. According to Bank of America Global Research Report on Friday, investors shed stocks at the highest weekly rate ever in the week to Wednesday, with a sell-off of net $41.9 billion. With many leading stocks came under further pressure, some investors then wonder, what's next? More sell-offs? To be honest, nobody can be sure, but I am still of the view that we may have a mini relief rally or so-called oversold bounce around this period, which is the final week of the year till the first few trading days of next year. This period is commonly known as the center rally period. Just to share with everyone, history shows the market still has a chance to narrow last few weeks' losses, as US stocks tend to rise during the last 5 trading days of December and the first 2 days of January. And guess what? The start date of this 7 trading days window was last Friday, where the broader market had a little bounce. Such bounce happened about 75% of the time. That being said, do note that past performance doesn't mean it's a given that the stocks will rally this year. Okay, so that's the 75%. How about the 25% period where we did not have a center rally? Interestingly, a December without a center rally has been followed by a weaker than average year. This is the data from LPL Financial going back to 1950. Anyway, going back to my view, if a rally happens during these 7 trading days, it will be none other than a relief rally. The reason is simple: negative sentiment and weak macro factors don't change because it's a Christmas or New Year period. I mean, traditionally, December has been a strong month for the US stock market, but this December's performance has shown that the market does not really care about seasonal trends. They care more about the Fed, the economy, the growth in companies, and the overall macro environment. And all these headwinds will continue into 2023, at least for the first half of the year. Okay, now let's check out the technical chart. As usual, starting things off with SPY, which held up quite well over the last 1 week. Check out the last 6 candlesticks. They are all trading within these 2 Fibonacci retracement levels between 377 and 385. Sadly, by doing so, it is not showing us any clear trend at the moment. Likewise for MACD and RSI, both are not painting any clear bullish or bearish direction. But if you look at it from another angle, one may argue that since we had the 5 straight red candles, SPY has stopped its rot as we started to move sideways, and sellers could have exhausted. Hence, in the near term, we may not have a drastic fall. If anything, it could remain at around this range or have a little rally till the next big event. Anyway, this is just one narrative and there can be lots of narratives. Therefore, it is more important to watch the price movement. So in order for that slight bullish thesis to materialize, SPY needs to break and stay above 385 to 386. Because other than the 38.2 Fibonacci level, that is also where the 50 moving average sits. However, do note that intraday movement is not counted. We need at least 2 or 3 candles above this level, then the bulls could gain a little control and potentially push it upwards to fill that gap at 393 to 394. That is where a heavier resistance is. As for the bear thesis, on the downside, if nobody is buying in the current weak climate and investors continue to sell their stocks for tax harvesting purpose, watch out for 377 on the downside. We tested this level on 3 or 4 occasions last week during intraday, but somehow SPY bounced back up again. That is where I meant by the importance of key support and resistance levels. Below 377, we have another layer of support at 370. Now let's say if 370 breaks in the upcoming week or weeks, there is a chance that we could waterfall down to a 355 or even retest the recent low of 346. And that is a good 15 to 20 points downside. So if you are a bull, set a stop loss. If you are a bear, your puts will be printing. Once again, this is not a financial advice and nothing is guaranteed. And before I move on, do you recall previously I shared that whenever SPY hit the red dotted downward trend line, it tends to get rejected and move downwards? So far, it has been playing out as such. Here's another interesting thing that I spotted. Each time it went down, there is a meaningful rally. It happened the last 3 times. So will it happen again this time, the 4th time? I don't know, I am just sharing what I have spotted. Again, it's all about probability. So now let's move on to Apple. Apple is currently sitting at a decisive level. Can you see the downward channel marked out by the 2 red dotted trend line? For a bull case, buyers have to start stepping in quickly. At max, bulls can only allow it to go down the channel a little bit, just like the previous 3 occasions. But it has to bounce up quickly to form a bullish double bottom formation with June's low of 128. When that happens, watch out for 138 resistance level. If we can break and close above it, then Apple has room to go to probably around 144 before it hits the top of that channel, which is a resistance level. On the downside, wow, it's potentially quite massive. As I zoom out the chart, you will be able to see that Apple has already entered this consolidation zone of 118 to 134. So the longer it stays here, the higher the probability that it will drop to sub 120. That was what happened to Tesla when it entered a consolidation zone of 120s to 155. It plummeted from 150s to 120s. For me personally, I am paying close attention to June's low, which is 128.6. It's either we have a double bottom formation or we slide further down to sub 120s. Regardless of which direction, it's about 10 points movement, and in Apple's context, that's quite a fair bit. Alright, let's move on to Tesla. What a week it had and what a year too. Down about 20% last week and down close to 70% for the entire year. Some quick thoughts before I go into the technical chart. The reason why we had a capitulation light of decline last week could be due to 3 reasons. First, tax loss harvesting, which we talked about earlier on. Second, margin calls. There could be some big players that got margin caught and forced to sell their shares. Third, potential demand issues. The recent price cuts and overall production slowdowns in China could be interpreted by investors as a drop in demand. Whether it's indeed the case is a long debate, so I will not delve into that. Anyway, those are my speculations. Whichever the reason, it is a fact that Tesla has fallen quite a lot. Okay, now let's have a look at the chart. Looking at the RSI, Tesla is extremely and severely oversold. In fact, if I'm not wrong, the RSI has never ever reached this oversold level since Tesla's IPO. Meaning to say, it's the first time Tesla has ever reached this oversold level. The closest it came was around September 2016. So what does this mean? Again, it's all about probability. On paper, by right, we should expect some form of rally from this point onwards. But on the other hand, it's Tesla, anything is possible. So if nobody's buying and more investors get margin caught and had to sell shares against their will, the RSI could create another new low. My personal view is I wouldn't short it at the moment, though Tesla does look like a falling knife heading towards 100 and below. Anyway, if you had followed my last video, you would have known that I talk about this consolidation zone that ranges from 120s to 155. Now let me show you something. Tesla is sitting at the bottom of this consolidation zone. In simple terms, this is a support level, and it has to hold if bulls want to take over control. Otherwise, if we enter the next consolidation zone below, things may get uglier. That zone ranges from around 90 to 120. So if we officially get into this zone, there is a possibility that we could head towards 90. Not saying it will, but just saying it could. But let's say we have an oversold bounce, there is quite a fair bit of upside before we hit the resistance, which is at 155. Anything below 155, it's bearish to me, as simple as that. Lastly, gentle reminder to the bears, remember to take profits. A Tesla rally is no joke, but whether it happens or not, it's another story. My sensing is, when everyone is so damn bearish on Tesla, it could stage a comeback, even if it's a temporary one. Anyway, this is not a financial advice. Okay, moving on to Nvidia. If you had followed my last video on the shooting star candlestick and went bearish mode, your put should be printing money right now, as Nvidia tumbled about 8% last week. So what's next? Let me show you this support zone, and that is 147 to 151. 147 is the level where it has acted as a support or resistance level in the past. 151 is the 50 moving average. If this zone breaks, there is a high chance we will head towards the gap at the bottom to fill it, which is between 142 to 145. This level is equally important. If Nvidia doesn't bounce from here, can you see that second green dotted line at the bottom? That's the next support level, which is around 120. So don't be too surprised if we hit that in the event that Nvidia doesn't bounce from the gap. On the upside, temporarily just pay attention to 171, which is the 200 moving average. This is the level that it got rejected very recently. Below this, there is no reversal of the bearish trend yet. Alright, there will not be any video next week, so I shall share a bit more of my thoughts here before we catch up again next year. Anyway, my take is that the stock market remains shaky and under heavy pressure at the moment. And since a couple of months ago, I have shared that this weakness in the market will carry on to next year. And this view of mine remains. So, with such a weak market outlook, why am I still buying stocks? In fact, some may say this is a really bad time to invest in the stock market, as we are probably catching a falling knife, or many falling knives for that matter. My personal opinion is that at the end of the day, it all depends on an individual's investment plan, risk tolerance and time horizon. There is no right or wrong investment plan. Let's say if you feel uncomfortable putting your money in the current stock market, by all means take a few months break from the market and come back again when you think that the macro environment has improved. But here's the catch, how is one able to determine if the macro has improved? Fed pivot, inflation dropped to 2%, war has stopped, lesser layoffs by companies, the list goes on. You get the drift? The issue here is there are too many headwinds and things happening right now. How would we know how many of these headwinds need to be struck off the checklist before the market is ready to fly? Another question, what if a rally that appears to be a bear market rally turns out to be a bull run rally? By then, it will be too late for us to hop on the boat. Therefore, speaking for myself, I clearly know that I cannot predict when the market will rebound. The stock market could slowly grind to another new bear market low next year, or it could just move sideways for another 6 to 9 months. So you see, there are too many possibilities on how the market will move. As a result, I would prefer adopting the strategy of slowly and cautiously putting my money into the stock market as we grind out this bear market. To also clarify, I have made adjustment to my strategy this year as compared to previous year in view of the bear market. I held more cash throughout the year, and each and every time when I entered the market, I did it in small amount. Just that I'm not as extreme as investors who pull out completely from the market, put a pause to their investment plan, wait for things to turn around before going back in again. Anyway, whichever investment strategy you are adopting, let's hope we, as long-term investors, are able to profit in 5 or 8 years' time. With that, Merry Christmas again. Please give me a Christmas gift by liking and subscribing to my channel. Finally, Happy New Year to everyone out there. I will see you guys again in 2022.